Hey everybody, welcome to another episode of What Ted Says, where it's always time to get a fatter wallet and a bigger net worth. Towards the end of the year, people are always asking me about tax deductions. How can I save money before I file my taxes? So I wanted to give you 5 of my year-end most overlooked tax deductions. Let me start with my favorite 3 letters in the alphabet. No, it's not the IRS. It's actually called an HSA or a health savings account. Now, if you're tied to a high deductible health plan, you can be eligible for this health savings account. But where people get confused from a tax perspective is they think, well, if my employer puts in money, I'm not sure how much money I can put in. And let's remember that as a single individual, at least here in 2020, this will change year to year, but it's always a good year-end tax deduction. You can put away up to $3,550, and if you're a married couple, you can put away up to $7,100. The mistake that people make, and the reason that this is an overlooked tax deduction, is that people don't realize you can still fund your HSA, your health savings account, until April 15th of 2021, yes, for the 2020 tax year. So far often people think they've missed that tax deduction and they get a first quarter bonus, or you have some additional money in your checking account and you can max fund that to get that tax deduction for 2020. Let's not forget, we'll do this in another What Ted Says, you can actually invest that health savings account. Number 2 are charitable deductions, because we all like to be charitable, but little known fact right now is that underneath the CARES Act, which happened here in 2020, even if you are somebody who doesn't itemize their deductions, and that's the reason a lot of people don't think about deducting charity, you can still deduct up to $300 of cash if you make a cash charitable contribution, even if you don't itemize your deductions. That's a win that can save many of you somewhere between $50 to $75 in taxes. But if you do itemize your deductions, one website I would recommend going to is the Salvation Army, satruck.com. And in there, you can figure out whether or not you're going to give away clothes or appliances or furniture, or you just have some other collectibles, what they're actually worth when you donate them, because the Salvation Army actually has a guide and it will tell you what's a reasonable low value and a reasonable high value. But whenever you leave a charity, whether it's Goodwill, Salvation Army, a church, synagogue, or somewhere else, they're generally going to give you a blank receipt, and it's up to you to be able to say how much you actually gave. The better you itemize that receipt and the better you give the fair market value of what you exactly donated, the more you can be able to deduct on your tax return. The mistake that I say here is do not say I gave a bag of goods for $50. That's a terrible idea. Itemize and you can give more. Let's not forget that you should fill out Form 8283 if you're going to give non-cash charitable contributions of $500 or more. Number 3 is the catch-up. Yes, the 401k catch-up. If you turn the age of 50 here in this year, or you are older, you can do a catch-up. That means you can put away an additional $6,500 in addition to that $19,500, which means you could put a maximum of $26,000 pre-tax. And boy, wouldn't that be a great tax save before the end of the year? Tax deduction number 4 is the Deductible IRA. I don't know why I like saying it like that, but I do. But a lot of people think if they contribute to their 401k, that you cannot contribute money to an IRA and deduct it. And the answer is, it depends. Now remember, if you don't have any kind of retirement plan at work at all, they don't offer you a 401k, a 403b, a 457, or any one of those types of numbers and letters combined, then you will be able to deduct a contribution to an IRA. Even if you contribute to a 401k plan, if you're a single individual that makes less than $66,000 of modified adjusted gross income, or something called the MAGI, or you are a married couple and you make less than $105,000, you can still fully deduct that IRA contribution. Now, there are some phase-out limitations. For single individuals, it's all the way up to $76,000 for a partial contribution, and for a married couple, it's up to $125,000 for a partial contribution. let's not forget that no matter what your level of income, you can always make a traditional IRA contribution. The question is, can I deduct it or not? And if you follow the tips that I gave you today, even if you contribute to a 401k, you might have some cash on the sidelines to make a last-minute IRA contribution that could be deductible and put some dollars in your pocket. And the fifth and final overlooked tax deduction is medical expenses. Say what? Yes, medical expenses. You see, you may still be able to deduct medical expenses that are out of pocket. We're not talking about your health insurance premiums, but if you had that kind of year where you spent a lot of money because you had an injury or you had some other medical condition, you might be able to deduct it. And here's how it works. Generally, those expenses that exceed 7.5% of your adjusted gross income can be deductible if you itemize your tax deductions. So in this case, if you made $100,000 and your medical expenses exceeded $7,500, those expenses that are above that $7,500 can be deductible, including mileage, meaning trips that you made to doctor's offices as well. So one thing you want to ask yourself is, did you have an abnormal year, a year that you had a lot of medical expenses, and if you didn't, you paid a lot out of pocket, even if you met your deductible? That deductible in and of itself, if you had a $10,000 or $20,000 deductible on a high deductible health plan, if you met it and paid those dollars out of pocket, some of that money may actually be tax deductible. So look at that every year, because you're not going to have medical expenses generally that are going to look like that every year, but this may be the tax year, and I don't want you to overlook that tax deduction. Now, these are my top 5, but on the What Ted Says channel, I teach you things like how to read a tax return, what you should do if you hire the kids in the business. You might even look at business mileage with the IRS and what's tax deductible and what's not. So leave me your comments. Maybe you have a favorite tax deduction that I haven't thought of before the end of the year as a top one that you like. Please leave it for me. Please subscribe, and also share this video with your friends, because I'm trying to save them money. Thanks for watching.